going to do today is Matt Greenwald, myself, and Lisa Weber-Raley are going to run through some of our favorite findings from the 2020 Workplace Wellness Survey, which we reimagined with eBree to conduct this year, to focus more holistically on benefits, advice, and education in the workplace. Its predecessors go back quite a ways. The Health Confidence Survey, the Value of Benefits Survey, and the Health and Workplace Benefits Survey all were some of the predecessors and some of the trend that we've built upon here. We fielded the study in mid-July to very early August. We had 1,028 respondents, 900 of which are the ones we're talking about today, those employed full or part-time. We also separately surveyed 128 furloughed workers. So I wanted to kick us off just by talking about well-being in the workplace and how employees rated their employer's efforts in several categories: financial well-being, emotional well-being, and physical well-being. So about 4 in 10, a little more than 4 in 10 employees said that their employer's efforts to help them improve their financial and their emotional well-being was excellent or very good. And still another 3 in 10 roughly said it was good. And then slightly higher than that, nearly half rated their employer's efforts to help with their physical well-being, their health, as excellent or very good, with another 3 in 10 calling the employer's efforts good.
Hey,
And
Lisa?
since, yeah.
I'm sorry, can you remind me when exactly was the survey fielded?
It was, I believe, July 13 to August 6 of this year.
This year particularly, that's good to know.
Yes. And actually, we asked specifically on the next slide about whether or not those efforts from the employer appeared to ramp up during the pandemic or since the start of it. And about 3 in 10 say that they feel their employer's efforts to help them manage their well-being have increased. 6 in 10 say that they've largely stayed the same. Yes, it's only 3 in 10. To me, that's not necessarily a bad thing because the ratings were already pretty high to begin with. So staying the course may not have been such a negative. I always say though, if there are employers out there thinking we've really ramped up our efforts, why is that increased number not bigger? It could be a signal of a lack of awareness among employees. They're not seeing what the employer is doing for some reason. And then on the next slide, and this is really the crux of what this survey is all about, is how these benefits are contributing to employees' feelings of well-being. And right there at the top, the few who have a DB plan, it is contributing a lot or a little, 9 in 10, more than 9 in 10, to feelings of financial security. Health insurance has the biggest dark blue bars. 63% say it's contributing a lot to feelings of financial security, and retirement savings plans are contributing a lot to financial security. So that's what we're going to focus on. That's what Matt and Lisa are going to focus on, is the retirement benefits and the health benefits, which are clearly so important to employees' overall well-being. So I'm going to hand it over to Matt to talk about some of our retirement findings.
Hey, Lisa, sorry. Yeah, before we go, can you go back just for 1 second? So it looks like 311 of the survey participants had a DB.
Yeah.
So that's roughly a third of the respondents. That's quite a bit higher than, nationally, which I think is about 16 or 17%. Do you have any insight into why so high?
Not specific to this study, but years of RCS has taught us people often over-report. They don't understand the difference between DB and DC, so we do see some misreporting in what people claim to have.
Exactly what I expected you to say. We see the exact same thing, and the interpretation of a 401k as a DB, I think is more prevalent than we'd like it to be. So thank you.
Okay, well, first of all, I'd like to, in turning to retirement, say also how glad we are to work with EBRI on this study. And as further background, recall that the onset of COVID led to a massive change in the economy, the end of the longstanding bull market, the biggest drop, I think, in stock market history, and the displacement of a significant, rapid rise in unemployment and economic uncertainty. And with that, a lot of retirement plan providers recommended staying the course. And if we go to the next chart, we see that by and large, in terms of investing, there wasn't a panic, although a lot of reason to. And most people did, in fact. We asked them, have you made changes to either your retirement plan contribution or the way your retirement plan savings are invested since the start of the COVID-19 pandemic? And 70% said no. Now, with the change in interest rates to historically low levels, one might wonder if that is wise, and maybe more people might have made some adjustments. But the fact is, people stayed the course by and large. And didn't panic, although 30% is still a significant figure. I'd like to also put this in the context, if we look at the next chart, that we've seen, and especially through the Retirement Confidence Survey, an expectation of working longer. And now we have a situation, and this is when people expect to retire, that 1 in 4 expects to retire at age 70 or after, or never. And 26% don't really have a target. So we see an expectation of working longer, which is, and we'll talk later, is not always realized because of, usually because of ill health. But this change is taking place in an expectation or goal, let me put it, that people work longer. If we go to the next chart, we will see that there's an expectation, although most people, 7 in 10, are going to say the course and haven't adjusted their target retirement age. 1 in 5 do plan work, I'll put it this way, even later. And there are some economists who believe that with low interest rates, investment returns overall will be lower, making it harder for people to accumulate enough, and that will also push people to work later. But we do see 1 in 5, because since the start of COVID, have changed their plans and now plan on working later. And if we go to the next chart, we will see that 42%, 2 in 5, don't really feel that they're prepared to handle retiring 5 years before they plan to. But we do know, consistent findings of the Retirement Confidence Survey, that about 40% of people do retire before they plan to. So I think we have to think about how these changes in workforce participation should change retirement planning. But as people hope to work longer, they're even more likely to have to not reach that goal because of ill health. And most people are not prepared. Not most people, a significant minority of people are not prepared for that. And let me end by just talking about some research we did. Next chart, please. Getting back to the key point, we sort of melded together the Retirement Confidence Survey and the Workplace Wellness Survey, and we see, in terms of the impact of COVID on retirement confidence, well, I'll call a very slight decline. So people are not, this has been a massive event which has not led to a massive reduction in retirement confidence. People are staying the course and by and large have had only a minor impact on their expectation of having a financially secure retirement. If that's confidence or false confidence, we will find out. But that's an overall, key part of the findings that we've had. And with that, let me turn it over to Lisa Weber-Raley for comments on health insurance.
Great, thanks, Matt. Just wanted to say thank you, Matt. Thank you, Lisa. You both talked about two things that jumped out at me as well. First, Matt, the idea that a health event can happen and force workers out of the workforce at a time when perhaps they're not mentally or financially ready for that. And of course, Lisa, at the top of the presentation, you showed how employees' opinions of how their employers are taking care of employees' physical, emotional health is really intriguing, especially during these times when obviously the pandemic is a physical health threat, but it also is an emotional health issue and a financial one. So to that end, on the next slide, we asked employees how they felt about their employer's job in communicating about different topics. And top of the list, right about half felt like their employers were doing excellent or very good job at communicating about COVID policies and procedures since the start of the pandemic. Right about half feel like they're doing a good job with and communicating about health insurance and healthcare. But you can see that those communications about mental health, work-life balance were towards the bottom of the list, just under half, about a 10 percentage point difference between sort of employer communication about nuts and bolts of what we're doing in response to COVID versus encouraging a work-life balance. And then on the next slide, the next finding that jumped out at me was this question we asked about employed people's sentiment with regard to the healthcare system. About 3 in 10 feel like the healthcare system in the US is excellent or very good. That is a trending upward over time. About 6 in 10 say it's good or better, and that's an increase obviously over prior years. And we do see a similar pattern when we ask about satisfaction with health insurance on the next slide. So we're starting to see that more than half are very or extremely satisfied with their current health plan. And that's up from 2 years ago. And, you know, you have to wonder if the climate of the pandemic is influencing both of these things. People are constantly seeing information and news about the health system's reaction to the pandemic. And they're also, you know, this is a group of people that are employed. They were employed in July. They had health insurance. And so there may be a feeling of security of having that health insurance. And obviously, I'm sure you all got the emails. Health insurers did a lot to communicate with their members, their consumers, about the things that they were going to do in response to coronavirus, covering tests, covering treatment. So I certainly think some of that is playing into those employees' overall perceptions of the health insurance system or healthcare system, but also health insurance. And on the next slide related to that, we see that 3 in 10 employees say that they have taken advantage of employer provided or benefits company provided education or advice. And what's important about this is the charts on the bottom. When they take advantage of that education and advice, they understand their benefits better and they are more satisfied with those benefits. And I think this is really important from an employer or a benefits provider perspective, is connecting employees with that education and advice. When they understand their benefits better, they tend to be happier with those. So that really jumped out at me in terms of things we saw in the workplace wellness survey. And then finally, really quickly on slide 17, I wanted to talk a little bit about this slide. So we see about 1 in 3 employees, they told us in the survey that their healthcare costs increased. And it's fewer than we've seen in the past in the historical trend. Healthcare costs are not just premium. They are deductible. It's cost when you're seeking care, prescription drugs. And so this is a little counterintuitive to me. We know that premiums are rising. And so maybe there are some employers that are getting to that threshold of saying, we just can't pass on premium costs to our employees anymore. We do know that high deductible plans are pretty prevalent. We'll have some research coming out with EBRI, the Consumer Engagement on a Healthcare Study, which will talk a lot about high deductible health plans and trends in those. So look out for that. But we also have seen a dramatic shift in terms of the delivery of care system in this country over this year. We had a period of time where essentially preventive care visits, elective surgeries were just completely stopped. And so it could be some of the impact in terms of actual care costs have sort of, there was a period where employees were just not spending the dollars that they would have spent along the way. So now that the country is sort of starting to open back up, and in July, depending on what part of the country you were in, you know, providers were starting to see patients again, and that backlog of visits was starting to be caught up. So I suspect it's a multitude of things going on here. So Lisa, I'll turn it back over to you to talk a little bit about some of the wellness findings.
Wellness and financial wellness, you know, the topic that ties it all together. So let's start with who has access. This year we found just over a third of employees saying that their employer offered them a chance to participate in a financial wellness program. That's harking back to what we captured in 2015. It's up a little from the 2018 number. But one of the findings I found really interesting is on the next slide, and that is financial wellness more important now than prior to the pandemic? And a little more than a third say yes, it is, and about half say it's the same level of importance. So I think the spotlight on wellness and well-being that we see in the industry is well placed. There are people who feel they need these services more than before, and some who feel it's just as important. Certainly only a few feel that the need has diminished. And on the next slide, I want to talk about where well-being, education, and advice efforts may be best placed. So we asked, what would you want your employer or benefits companies to talk to you about? And really rounding out the top of the list is retirement. So you have how to invest, how much should I save for retirement, how to use my retirement savings to generate income in retirement, how to transition from work to retirement, a little bit of a softer topic, what that transition looks like. And then bridging the gap at 24%, interested in how to manage healthcare costs in retirement. So here's the overlap where Lisa and I get to live together. You know, 24% want education on how to manage healthcare costs in retirement. And then just around 2 in 10 are curious about how their health insurance works, how an HSA works. And then slightly fewer are interested in wanting to know how much to contribute to that HSA. And then the others, I also found interesting. So the only other non-health, non-retirement topic to really rise towards the top was building an emergency savings fund, which I think is really a crucial part of general financial wellness and financial well-being programs, is helping people manage their finances in a way that an unexpected expense isn't a devastating event. And then following that, you really see sort of a split, just lowering financial stress in general, and also some help with wills and estate planning, some interest in that from about 2 in 10. And as you might imagine, these look very different by age cohorts and what people are going through at their current life stage. So I think with that, those are our favorite findings, and we are happy to answer questions. One thing I will note on the retirement confidence question and analysis that we did, that trend line, even though it looks like it went down about 4 percentage points, is not statistically significant. So retirement confidence directionally coming down, it is not statistically significant. Questions, comments?
A question. You had the question there about to workers about their view on the importance of financial wellness, and you know, how does that? Have you ever tried to? I mean, I found there's a lot of confusion in the industry among what actually is financial wellness. And it's a fluid definition, and it can cover everything. I wonder, have you had any sense of how do employees have any better sense of that than how, say employers do? But I mean, when you ask employees a question like that, what do they mean? What do they mean? What do they see financial wellness as being?
So drawn more from experience in this survey, for every person you ask, you get a different answer. That includes employers. For every employer you ask, you get a different answer. I could probably get a different answer from everyone on this phone call as well. So we define it for them in this survey, so that we're trying to capture what we intend, what sort of the industry definition is. I don't have it at my fingertips, but I can share it. Because without providing the definition, the comments and the responses might be all over the place.
Well,
We also did a survey of executives in financial services, and that was also all over the map, with the major definitions being either preparing for retirement or managing budgeting and finances overall. And some people also referring to life insurance, disability insurance, and protection, even within the businesses you alluded to, all over the map.
Well, I think it's good that you provided the definition. Lisa, that would be, I think that'd be a great start. I think one of the things, I think Lori and I have talked about this before. I think at some point, it's like we all could stand to have a good, solid, consistent definition. We might, any one of us might disagree with it or might want to tweak it, but knowing that as a foundation, I think is really important to understanding and communicating more effectively about this kind of stuff, is to say, this is what we mean by financial wellness. At least then people have sort of a benchmark, because I think what happens a lot of times is we see data about, and it's phrased as something relating to financial wellness. And what I've seen is people have a tendency to take whatever those findings are and apply it to their definition of financial wellness. And that's not always the best linkage. And I'm sure from your own standpoint, if you see your findings related to somebody else's definition of financial wellness, you say, well, no, that's not what we talked about. So I think that it's great that you do that, and it would be helpful to have that.
Yeah, and there are a lot of studies we're doing on financial wellness these days for a variety of organizations, and I think my viewpoint, whether it's qual or quant, is that we almost always, if the focus of the research is financial wellness, we start with the question of how do you define it?
And we actually did some focus groups a couple of years ago as we were beginning to develop the employer financial well-being survey that we do, and we gave cards to employers with written definitions of financial wellness, and I even gave them a blank card so that they could put their own. And what everyone, there was to everyone's point, there was a lot of variation, but what the employers seemed to coalesce around was the idea of a balance between current financial stability and future financial security. So this balance, and they're concerned that they want people not just to be saving for retirement, although that's really important, but also that they have current financial stability and resilience.
So Lori, this is Jody. Isn't that somewhat related to the CFPB survey?
It is. That's exactly their definition. Yeah.
Any other comments, questions?
At least on the retirement confidence question, you mentioned that it was not statistically significantly different, but the results were, when you parse it out for those that were furloughed or laid off, there was some big differences, right?
Oh, tremendous. Furloughed workers' confidence was, oh gosh, down in the, it was half, down in the 20s or 30s. the rug had been pulled out from under them. I mean, if the retirement plan, the workplace retirement plan, is contributing to the feeling of financial security or retirement security, and it's not there anymore, you know, we saw with the furloughed workers really everything you would expect: confidence down, needing more information this open enrollment season. Wanting things mailed home instead of online, but certainly all the satisfaction metrics all lower for furloughed. So I had a question for Lisa. You know, knowing that CEHCS is coming, and we're excited to see some more health focused results. What was your take on the impact of the third who saw increased costs? What's happening with their behavior? How's that impacting them?
So thankfully, you guys asked some really great questions about that. So we know that they're making quite a few changes in response to when they see healthcare costs. So they stretch their personal finances, right? So they increase credit card debt, over a third of them, a third borrow money or take a loan, lower their savings. This is alarming. 3 in 10 have difficulty paying for bills or basic expenses or necessities, or use up their savings. So we know that's happening. Personal finances impacted. We know that they change their benefits. So a third drop some benefits, another third say they buy additional insurance, 39% look for cheaper health insurance. On retirement, they make changes. A third plan to work longer. A third take a loan or withdrawal out of their retirement plan. 1 in 4 put less in their retirement accounts to make up for that increase in healthcare costs. And then on the health side, there's some interesting choices that people make. Not always good. So about 4 in 10 delay going to the doctor. 45% only go for more serious conditions. That's not good because that will increase costs in the long run. 35% don't fill or they skip a medication. They're also doing some good things, right? They're talking to their doctor about treatment options and costs. That's about 4 in 10. They're getting coupons and discount cards for prescriptions or switching to OTC medications. But, you know, that's kind of a mixed bag. I would say on the whole, a lot of those things are not great for their long-term financial wellness.
All right, and one for Matt, because we've gone back and forth on this a little. You know, at the start of the pandemic, I think a lot of retirement plan providers went out there with messages saying, we're here for you, stay the course, don't panic. And with 70% not making changes to their plan, I considered that a success, at least a marketing and PR success, that message came across. But Matt, you actually were a little concerned that maybe more people should have make changes. Explain your viewpoint a little bit more on that.
I think it's a key issue and an opportunity for thought leadership. We've gone from a low volatility bull market over 11, 12 years to a period where interest rates are very low, where there's more volatility, where there's more uncertainty. And the question is, should people make an adjustment? We've done research with advisors and they have very mixed views. But so again, some people think that if you're going to try to manage investment risk by putting a significant amount of money in fixed investments, they're just not going to pay that much and that's going to drive rates down. So I think a crucial issue now is this a significantly different enough investment and interest rate environment that some shifts should be made, or that some increases in savings should be made to overcome a likelihood of reduced returns. So I think it's a crucial issue for the industry. And again, for thought leadership, let's not just reflexively say, just stay the course and do the same thing in the face of an investment climate that is not the same. That's an interesting issue to me.
Anyone else have thoughts or viewpoints on that?
Well, first off, you've got a lot of people in target date funds now. And they've been put there and they've been told there that you don't have to worry about that kind of stuff because we got people who know what they're doing taking care of that. I suspect that probably factors somewhat into the considerations. The other point I'll make is I'm one of those people who, when the bottom dropped, I mean, again, by July, August, the market was back. Okay. And everybody who remembered, the caution we got after the 2008, like stay in there and it all comes back and more, I was feeling pretty good. I was one of those people who in mid-March, I moved money into stocks because I know how this works and I don't need the money tomorrow. And I've been very pleased with that result. It's worked out well. Now, you know what? With an election coming up, guess where I'm going? Take it off the table, set it aside. Let's see what happens. But I do think that the target date factor, probably longer term, as you look at macro trends, is probably going to have a factor there. And I think not do that. But I think a lot of times, what people have been told, the problem is not, and the other thing is, how were you allocated to begin with? Maybe you're okay. To your point, Matt, I think people who are paying attention probably were better, better positioned than a lot of people have been in the past. But I think the problem, by the time you get the drop in the market, that is like the wrong time to be doing pretty much anything. I mean, that's, but the key, and this is a conversation I've had with a lot of advisors, is that, but when you get past, and this is the conversation with investment committees. Okay, we missed that one. Now, what do we want to do going forward? How do we want to lay out whether there's investment policy statement or whatever? Now, that's a committee thing, but it also applies at an individual level. And I think a little bit, I think to your point, Matt, what we've just gone through should be a wake-up call to everybody, not to panic, not to do something stupid, because people who panic inevitably do the wrong thing at the right time. But to sort of take this as okay, this is going to happen again. Are we in a good position in case it does? Because it will, sooner or later. But
so I think you put a spotlight on the most important issue, which is a down market's not a time to sell low.
Yeah.
To that extent, staying the course is exactly the right thing, and it's been a success.
Yeah.
Biggest drop ever, and most people stayed the course and didn't give up, and there's still a lot of confidence long term, which is great. I think the interesting issue is now, and it's a great lot of people have target date funds where these issues are taken out of the hands and given to professionals. That's right. But still, I think for the industry, to what extent do we react to different climates in strategically different ways? It's a more complex message, but I think something worth thinking through. But again, the key point and the success is don't panic and sell low. And I think that's always a good idea. Well, I shouldn't say always. As long as
never say always. Never say always. Never say never.
So this is
Good.
Jack Warnicki. If I can add one more comment to add on to Nevin's. Most participants don't really know how their target date fund is actually allocated. And the second thing is that one thing that hasn't changed from 0809 is back in 0809, 2010 target date funds, a lot of them had allocations to equities in excess of 50%. And this time around in 2020, that was still the same. If you had a 2020 fund, most of them had an allocation. In other words, the target date, the time payouts are supposed to start is 2020, and they still got allocations in excess of 50%.
Jack, that's a great point. I'll tell you, we had one of my 401ks switch record keepers January 1st, and they bridged the investments. I'd been in a managed account there, and they bridged it over into basically target date funds. And sort of after the dust settled, I went in and looked at they had defaulted into a 2020 target date fund. But the philosophy on target date funds writ large has gone from being to retirement date to an assumption that it's through retirement. And those of us on this call probably know what that distinction means. But what it means is that I think a lot of individuals out there who think I'm getting ready to retire in 2020, therefore my portfolio is going to be relatively conservative. I mean, to your point, Jack, the one I'm in, which is not a no name, I mean, it's a top notch, low expense thing. And it was more than 60% in stocks and more than 20% in international stocks. I'm betting your average defaulted into that fund retiree does not think that's what's going on. Whether it should be or not, it's a whole other question, but I suspect they don't know that.
Hey, Matt, this is Tom. Thanks for today. It's always good to see you guys keeping us informed. At John Hancock, we're seeing everyone staying the course practically as participants kind of ride out on their investments, but we're a little bit concerned about the uptick we're seeing on the CARES Act and the access that folks now have to take these withdrawals, right? And so we're seeing continued uptick, and that's related to the struggles that households are having. But we're trying to, of course, accommodate that and do all that, but also message the importance of maybe not taking out too much or whatever it might be. But that's the current struggle right now that we're seeing in the data. The CARES Act access and the increase in those withdrawals are a little bit concerning to us.
Yes, and I think that raises an important point about how big a hit we're now taking to future financial security, and all those withdrawals now are going to be a setback, and the plan to just work longer is not going to be effectuated by everyone because of ill health, that especially as people want to work into their 70s. So I think you raised an important point. Thank you, Tom.
Hey, Tom, let me ask, I'm curious, how is that recent? Because, the trend line so far has been that we didn't see a lot of panic, but our concern always has been that when we got past the expiration of all the government unemployment money, which of course now we're dealing with that being gone, that our comforted timeline, that it would evaporate, that to your point, once that assistance ran out, people would sort of then be forced into that. Are you seeing this trend come on recently, or have you seen it all year?
Yeah, that's the timeline is important, right? And I don't think we saw it right away, but I would say starting middle summer, we started building for our clients. We call them the COVID dashboards, but it's really these data points that folks can understand within their book, within their plan for sponsors. What is happening in particular to CARES Act and withdrawals, and so I would say around July, we started seeing an uptick, and that has continued. It's I would say it's not worrisome, but it's a trend, and it hasn't stopped.
So Tom, when we asked in this survey in mid to late July, if folks had taken a loan or an early withdrawal since February 1st, 2020, so really because of or during the pandemic, we had 9% report that they had done so. Are you seeing numbers like that or higher than that?
That's all relative, right? We're seeing a consistent uptick in the weekly reports that we watch, and then again where clients are having some concerns too that they're seeing in their book. They're asking us, how do we help our participants manage through this? And people are hurting. If someone has a job right now, someone in their household probably has been impacted, and so I think folks are, seeing this as an opportunity to shore up the household in a sense. But where it stops and where the trend we're seeing right now is going, it's a little bit concerning.
Lisa, are we seeing that withdrawal higher among furloughed?
I don't have it in front of me. Oh, yes, I do. Wait. More like. No, there's a difference it looks like there's a difference in the reasons furloughed is taking. the loan, but not necessarily a difference in the percent who are actually doing it. So furloughed is much more likely to do it because of health.
Okay.
So one of the things that I thought was interesting is the 27% interested in how to generate retirement income and looking for more help from their employers. Do you have any additional color around that and what that means?
We have a great study called the Retirement Confidence Survey.
I think I've heard of that.
We absolutely, we put retirement here in the workplace wellness because it is, of course, so core to wellness. But the Retirement Confidence Survey digs a little bit more into these issues of wanting more help with how to generate income. And the RCS found it in 2020. We'll be asking again in 2021. And we did really ask quite specifically what that means to people in the 2020 RCS. And those numbers I don't have off the top of my head, but if I recall the findings, it was really still centered around some retirement basics. How much to save, help me think through my spending, help me think through healthcare costs, right? We're sort of at the crux of how much income am I going to need?